Welcome everybody back to our webinar series Developing Superb Trading Strategies. My name is Stefan Friedrichowski, as always at that time for those kind of webinars, but that I know that you know it. So by the way, if you want to reach me via email, you see my email address friedrichowski@argosfx.com, and thanks to Argos, they make that webinar series possible for all of us, and that's quite nice. Yeah, as you know, I have to remind every time for the so-called risk warning, because we talk about trading strategies, and therefore it's important that you know that if you trade always on your own, and there's nobody else responsible for your trades than your own. Okay, but that I think you know. So topics for today. I go first to some question and answers. There have been two, and one still a little bit open, at least in the complete content, but I will follow up, of course, on that. The other was related to our seasonal, DAX seasonal, and how does it work. I will show in a minute. Yeah, then I found, because last week we talked about so-called Renko charts, and I found a better indicator for that. I want to make some additional remarks on Renko because the concept is quite useful for data compression in order to better backtest any strategy. So there's an idea I want to share with you because I think it helps quite a lot to have less data, but still the same kind of information. And then we want to go further into that topic, looking for a trading edge. You know that we need some predictive power, something which tells us from now to the future, because we want to open trades, and those trades have call it an anticipation to the direction. We open a long trade for euro US dollar, of course. That means we expect the price to increase, and we should only open a trade if the prediction goes exactly into the positive direction to the north, and that is what I call here the trading edge. And we want to dig into that topic a little bit deeper now, because there are new things to report, but even additional methodologies I want to report here as well. And the method of choice here, and for some further analysis, is called KNN, which stands for K nearest neighbors. So K is a number like 3 nearest neighbors, 10 nearest neighbors, and so on. But you will see that is a quite impressive methodology, extremely easy. And I want to introduce that methodology first, and then show some results for our activities around looking for trading edges. So that is close related to each other. So, but let's start. First was that I should show once again a little bit on our strategy, DAX seasonal, or the week of day trading on DAX. And what you see here is simply the account. For example, today we opened a long trade because we have Thursday. Thursday is a day we trade into the direction of the EMA, and you see that EMA within the chart, we are a little bit above those EMAs, and therefore we open a long trade, and it's not a reverse day, therefore it's really a long trade. And that long trade, for example, is a little bit in the minus as we speak, but the trade runs until the end of the day, which means 10 o'clock in the evening, or the trade has reached stop loss. So if it has not reached stop loss, then we will close the trade close before 10 10 o'clock, and that you see how it works up to now. So you see an account here with 25,000 euros starting value. Right now we are a little bit in the plus, and that you can see it a little bit better what was the sequence of trade up to now. Let me open the detailed statement here that we have a view on the history, and you see that we have closed already 13 trades, so with 13 trading days, and yeah, you see as always it goes up and down, and there was one very good day that was 21st, that is Tuesday. You know, this Tuesday there was a very good short trade, and therefore, yeah, that's the main reason that we are in the profit region right now. Yesterday was a minus trade, but let's see. You know that a statistic of 12 or 13 trades for that kind of strategy is by far not enough. We have to wait, honestly, 1 year in order to really judge that kind of strategy. So keep you updated, but of course, right now it looks nice because we are in the profit. Okay. Anyhow, we see how the strategy works and how we open trades, and that's, by the way, a quite easy strategy. You can even do it manually, just at the open of the DAX trading. That is 8 o'clock here, and all you have to do is you have to compare the current the opening, compare it to the EMA, and then look for the day of week. And yes, it's quite simple, the rules. Only Tuesday and Wednesday are what I call reverse days, which means if we are above, then we would still open short trades, and vice versa. Okay, so that's for that kind of strategy. The other point I want to mention, there was a question, several topics, but one topic was about machine learning. And I put here 2 links, and by the way, you know that you can download my slides via your GoToWebinar control panel, so then you have directly those links. For machine learning, which I personally think is an extremely important topic for trading. There are so many developments from algorithms as well as on computer that we more and more can use those kind of technologies, and that topic in general is developing extremely fast. It's one of the main topics, for example, for today exhibition, or not today, this week I think it's called CeBIT. That's a computer exhibition in Germany. And yeah, by the way, what's the main topic? Machine learning and artificial intelligence. So that's really important, and it will come into our life in thousands of different aspects, but we look only from trading perspective on that. And if you follow those few 2 links, let me just show you both, because there are some important additionals. So the first one is this one here, In-Depth Introduction to Machine Learning. And that is a video course, and it's simply for free. But what I want to emphasize here is that they refer to 2 books, and one is, for example, an introduction to statistical learning with applications in R. R is a standard programming language for statistical applications, and I press that link right now. Because what I want to show you that you can download both books, the Introduction to Statistical Learning and the Statistical Learning itself. You can download both books for free. You get a PDF document, so it's then you have it at least on your computer, and you don't have to buy the book. And that's really a complete course here. And you see the kind of elements and statistical learning, linear regression. By the way, linear regression we will use today, and we will look for some other, which is here, k nearest neighbors. So you see two topics from today webinar here within those slides and course as well. So it's really an interesting point, and k nearest neighbors is already here in the beginning. And in principle, I could use those examples of that course for my webinar, but I have done some own work on that. So that's the one I want to share with you, and just that you know that you can have those books here. And the other one is Stanford University. Of course, you know Stanford University, but there's a platform which is called Coursera, and that kind of platform works together with Stanford University. And there you have online courses as well. For example, machine learning from a quite well-known professor, Andrew, I have no idea how to pronounce his last name, NG, so Andrew NG. He's doing a quite impressive job, and I went to that course. I think that is now a new one, starting as we speak, more or less. And some of those courses are for free. Other are you have to pay, but anyhow, you will find your way here. And there are really hundreds and other topics quite interesting for us, being a trader, looking from a more statistical point of view on our data. Yeah, give it a chance, have a look here. So it's really quite impressive and very good, and it's absolutely state of the art. So yeah, well known university here. So that's for the two topics I want to answer here already. Some questions. There's still something to do for me, and I will follow up on that as well. An additional remark once again to machine learning. You see that what I do here right now with my latest activities around developing super trading strategies is really related to that topic. It's not already directly something like artificial intelligence, but I use exactly those kind of methodologies you find in machine learning as well. So it's really interesting. Next topic was Renko update, simply because two things. One is I found an indicator with the name Renko live chart, and I press this one here now. You see it highlighted in the left low corner. Renko live chart underscore read 600 underscore indicator. So that's a very interesting indicator because it creates Renko charts, and there are some minor mistakes because sometimes even the Renko charts have candle behavior and are not real boxes. But anyhow, the good thing here compared to the one I presented last week is that now the x-axis is a real time. So that's quite funny. You don't see it on the first view, but since I have activated the so-called period separator within the chart, and that period separator means that is the beginning of a day, and that are those vertical lines here. That is the beginning of a day, and what you see on the first view, if you compare Euro Swiss franc with Euro Australian dollar, is that there are a lot of vertical lines within Euro Swiss franc. What does it mean? That means you see here already on the x-axis quite a lot of days. So what does it tell you? Simply on Euro Swiss francs, there are no movements at all. So even looking here to 5 days, or 6 days, I don't know exactly. Not a lot of bars or candles or Renko boxes, and that you can see here on the x-axis that the time is already more than 6 days here. Still, what I've used here is the same kind of methodology, that my box size is a fixed percentage of the price. So I see the percentage movement of an underlying. And once again, what I want, like I simply enlarge here euros with francs, and you see just with one eye, one view, that doing trades on euros with francs, not a good idea. There's more or less nothing to do, so no movements at all. So you see hundreds, or not hundreds, tens of days here, and there's no price movement and no clear trend. So even for standard trading, discretionary trading, you see with one view, don't trade this one. Let's have a look to other ones like Euro, Canadian dollar. It looks a little bit better, but not that one. Euro, Australian dollar, that is good one, because we have here a very good upwards trend, and so on and so on. So still, I think it's interesting to use those kind of charts, but honestly, you have to give it a chance. It takes a while until you get used to it. Next remark on Renko charts. I know that a couple of you are quite heavily involved in doing back tests for years, and you try to figure out, can I use tick charts, minute charts, 5-minute charts, and so on and so on. And if you go into that kind of topic, then you realize, okay, if you go down the time scale, then the number of data increases quite heavily. For example, if you use M5 data and you use the data since 2004, you are at the edge of 1 million data points or 1 million candles on M5 base. And if you would go for M1 data, then it's a factor of 5 increase, so it would be 5 million candles. So that's still, you can handle that with today's computer power, but it will take a lot of time. The idea now is quite simple. Why not go for example, M1 data, but then as, let's call it, a pre-processing of those data, and you have to do that kind of job only once before you start any backtesting activities. Why not compressing those data with the concept of Renko? What do I mean? If there are candles which don't show real movements, then you can more or less skip those candles. And you can combine 2, 3, 5 candles if there are no movements within those, and compared to some starting point. If there are no moves, then you can combine those candles to one. You need some criteria when in time you, let's call it, open or create a new one, but that might be a percentage value, might be an ATR value, whatever. So the good thing is you compress more or less your data without losing real information, because if the price does not change, then why looking for those data? So you only need some rules, how many candles you combine, and when in time you virtually open a new candle, and maybe that candle finally is 63 minutes. If the price has not changed within those 63 minutes, so you can compress those 63 M1 candles to one without losing real information. So that's quite interesting algorithm to compress data without really losing information, and that downscales your number of candles. It, there are some drawbacks on that. For example, if you use standard EMAs or standard indicators, then those values are a little bit misleading, because those apply typically on closed data of those candles, and if your candles are sometimes M5, sometimes M63, and so on, you can't use those kind of indicators anymore, or at least you have to change them. But still, the concept is quite impressive, to compress the data, and that you really can go for extremely low timescales as a starting point. So that is something I have in mind, and I start to use that kind of concept already. Some results I present today are already based on that kind of concept. Good. So that's for Renko charts, and something which is possible for those who go really on extremely small time frames. Let me now go back to our searching the edge. Just as a recap on how we do it and what we do here, I have created now simply a picture. And that picture is Euro US dollar. In this case, it's, by the way, it's M5 data. And you might remember that I start always with, or what is my basic assumption? My basic assumption is that I use rate of changes with some specific periods, which only means I look from now, for example, 10 candles back, 20 candles back, 100 candles backwards, and so on. And that is exactly those lines which are now within that chart. So there's a, let's call it a starting point, which is the end of that chart. And then I don't know exactly, because I only draw some lines here. Maybe the first one is 6 candles in the past. I look where they open, and that is a red line. Then maybe 10 candles, 20 candles, 50 candles, 100 candles. I don't know exactly the number, but you see what I mean here. So we get in total within that picture 1, 2, 3, 4, 5, 5 different values. And those different values are, for example, percentage changes, absolute changes, or maybe you calculate those changes in units of ATR, whatever. But we have 5 numbers. And those 5 numbers represent a status. Something like a single number, or better to say a 5 tuple, no, a vector of 5 values. And those 5 numbers represent the current status. And one of those questions, in order to come to that predicting the future, is, okay, that is the current status. Did we have had in the past similar situations with the same kind of status? And how was then the future? Because if we do that exercise really in the past, we know from that point in time always the future. So, and that is a kind of learning algorithm or learning data set. And the basic concept is, are those, for example, 5, I later will use 10, but different ROCs, rate of change numbers. And so that's the base. And the question is, and that's the reason why I say trading is predicting the future. And I mentioned already in my introduction, yeah, what does trading mean? We have now, if we want to open a trade on euro US dollar, what does it mean? We need an expectation for how the price will go on, and therefore we have the question mark here. And for sure, I would only open a long trade if my prediction is positive, so to the north. And that's the way how I now currently look to that kind of trading activity. I have a prediction, then I know maybe I can open a trade and then go on. And that analysis, by the way, with those 5 lines or 5 rate of changes, we can do every 5 minutes, for example, or if you look for Renko charts, whenever the price has changed enough. So I don't care right now. And then we can repeat always the question, how or what is now our predictive value? And do we have a change? If yes, we may change our position. If no, let's wait, and so on, or even reverse our trade. So that's the basic concept, and I made that picture today morning, and after I think 2 hours, I looked once again to the same picture because the price went on, and of course I have no idea at that point in time how was my prediction for the future, but at least what I can see, exactly after that point there was quite impressive movement. And funny enough, if we look a little bit later, so I can do it as we speak because I have still the picture here, and let me look to the chart, and now it looks like this one here. So it's still the same point of interest, and now we can really see the further development in price. Okay, so that's the basic concept, and in summary, it means that we look for a relationship between rate of changes and the at least short-term future. And I don't want to go once again really through that slide because we have done that task already last week. But let me go to the end of the slide. What I started to present you last week, that I looked to rate of changes classification results, and then finally I know a prediction for the future. And let's see how it works. First, and then I come to the next topic, K nearest neighbors. So we started with something like this. And just to, oops, once again here. So now I hope I get it. So what we did. One line is one point in the history. And what I have done here, I have classified my rate of changes. In this case, it was a rate of change period 1. And I looked how, from that point of view, was the future. And you see, I have classifications of rate of changes which are extremely minus for that one candle and extremely positive for that candle. So therefore, I used a little bit those colors. And the conclusion here was that if the rate of change is extremely minus, then we found always, what means always, statistically always, we have a preferred direction for the next coming future. And that prediction or that typical change in the future is in the same direction. That means therefore the bar here goes down. And we see exactly the opposite on the other side. If the rate of change period 1 is extremely high, so what does it mean? It means the last candle is a big bull candle, if I only use color language here. So if the last candle is a real bull candle, then the prediction is positive, meaning it shall go on. And that is exactly what we can find out here. We do the same kind of analysis for different rate of periods. And then I used a simple rule. And that rule was I looked for that rate of change in the history with the highest value of prediction. And that might be either, in this case here, the 10 or the 1. And then for some candles in the future, I applied that rule. So if I found a rate of change being in the same class, in this case being extremely positive, I would virtually open a long trade. And that was the way we looked for first equity lines. Let me show you the results here once again. What did we get? And that was the last thing I presented last week, the last chart. And what you see here for 3 different underlyings, euro, US dollar, euro, Japanese yen, and US dollar, Japanese yen, we see how good or how the prediction has been. And I have to remind you that we use the methodology of walk forward. That means I derive the rules in some history period. And by the way, this history period in this case is 288,000 candles. And I apply those rules for the next, and that is the name, step 720, for the next 720 candles. And applying those rules in the future and looking for the results is exactly that equity we have here. Oops, I don't know why this scales up and down. So now I have the scale back. So it's really getting the rules in some history, applying always in the future, and do that step iteratively. So like walk forward, as we have introduced a couple of webinars before. Therefore, it's quite impressive to have that kind of, let's call it a pseudo equity curve, because that's the sum of all predictions in units of ATR. And so it's not that bad. By the way, the prediction here is for 8 candles in the future. It's not very much. 8 candles in M5 would represent only 1 hour. Not 1 hour, a little bit less, 40 minutes. But at least that's what we see here. Still, I know, and I know that the next questions would pop up here. I know that that might still not be enough, because we have to trade that thing, and we have to incorporate all the costs like spreads and so on, which is not within the chart up to now. So there are no real trades. It's always the prediction and how good that prediction has been. But nevertheless, it's already quite good. If you have results like this, then you need some additional steps in order to investigate your results. For example, what about changing that back mirror? So the length of that back mirror, how many candles did you take in order to set up your routes? That's something I have done here, for example. So for different lengths of back mirrors, how many candles, and I looked here for 72,000 and so on and so on. But you see, if I use back mirrors which are extremely long, my equity starts later, because I cannot apply the same in the real more history here. But you see, in general, there's no big relationship. So it doesn't really depend on the length of back mirror. Very good. That's nice, because so it's not a real parameter. The other point of interest is, what about changing the step size? So how often do I repeat setting up new rules? In my first graph, it was every 720 candles. So now I have different step sizes here. Step sizes like 720 candles, 360, 180, and so on and so forth. And you see there's no real big relationship to that step size. The basic reason for that is simply the rules do not change that often, and therefore it doesn't really depend on that step size. So that's a good result to have something like that, because it means your overall situation is quite stable. Good. So having done those kind of analysis, I know, of course, I have a good basic concept. Back to the three underlyings. So next steps for this one here, of course, two possibilities. Either the methodology called position trading I introduced last week, so that look for the prediction, opening a trade into that prediction direction, and then wait with that trade, look for the next prediction. Do I have a change? Yes or not? Should I change my position? And so on and so forth. So that's one, and has to be done. The other one would be more similar to all previous activities, like, okay, let's look in the history. All those situations which have been similar to our current rate of change vector, and look, maybe is there a common rule for a trade, like a specific stop loss value, specific take profit value, specific lengths of that trade, and so on. And if we find a common rule for all points which are similar to here that picture of rate of changes, so those values, if we find a common rule, then we can use that rule for our next trade in the future. So that's the one. Good. But there's more to report, because I know now how to proceed, and I will do that step. But as I speak already, for those things which are with the wording of similar situations in the past, that exactly brings us to the point K nearest neighbors. And let me first introduce you a little bit that kind of topic, and then we change first to some Excel sheets just to show what it really means. That concept of K nearest neighbors uses, or what it does do, it tries to predict or to classify without any assumption for underlying laws or dependencies. You will see and understand what I mean here. So laws of dependencies or are, for example, a linear relationship between two or more variables, or a parabolic relationship, or whatever. So any kind of function, and if you don't have a clue on those kind of functions, and in most cases you don't have, then the concept of K nearest neighbors is very good. It's a more or less parameter-free methodology, beside one, and that's the number of nearest neighbors. So you will see how that concept works, and then there's only one remaining parameter, and that is how many neighbors should I take into account. The concept of K nearest neighbors is used really in machine learning and the concept of artificial intelligence, especially when it comes to so-called assigning rules. Assigning rules are, generally speaking, something like, if that is a situation and we have a specific situation, then do that, whatever that means. Think about Amazon recommendations of what book you should buy next. That is something which is called an assigning rule. Always it's done by learning from training data. And that is exactly what we want to do here, because we know rate of change values for different periods, and they describe a situation, so a history pattern. You might even think about candlestick patterns, which is similar to that kind of concept. And we can train our algorithm with historical data so that we know the future. At least we have a statistical assumption, or we can predict a little bit. At least that's the hope. But in order to get you better within that concept of k nearest neighbors, let me pick up here an example, and I have simply present those values and done here within Excel, but it's more related to the concept. And by the way, similar examples you find in those courses I mentioned in the introduction. Let's assume we have something as following. And please don't question the numbers here. All numbers I put into that Excel sheet are just fantasy numbers. So what if you have two variables or two numbers? You have something like a living space of a specific house, and that house has a price tag, or one might take those data from if you are a real estate company, from your previous selling operations, whatever you have done, and maybe you have those 20 or 15 values, and you know, okay, there was a house with a living space of 80 square meters, and I realized the price of, I don't know, 225,000, and so on and so forth. So, by the way, all the numbers are just fantasy, and don't interpret those data too much. And of course, in this case, we have only a few data. It's only it's two-dimensional because we have only two numbers here, and I can visualize it quite easily here in Excel. So I have a plot, house price versus the living space, so square meter of the rooms. And you see that one here. Why? Nice behavior. We can use, and it's more or less straightforward. If I now would ask you the question, hey, what is a typical house price for a house with 200 square meters? You find a way to answer that question. And in this case, the easiest way is what is normally called regression analysis. And it's really that simple as I do it here. I can do, for example, simply insert a trend line here. And now we have a line fitting our data linearly, because I use a trend line, which is formally a polynomial of the order of 1. And now I have that line within my graph. And by the way, that line would even have a formula, so I can really calculate the price, the typical price for a 200 square meter house. And now I realize, okay, exactly 5,065. I don't know, but I can calculate in principle extremely well that price. And that would be my prediction. And you see already a little bit of the relationship. We have historical data, and we want to predict something. So if there's a new house for selling, and you want to have a first estimate of a good price for that house, for that 200 square meter house, you would use for example, this methodology, which is regression, then nothing else. Looking from a more distant point of view, it means we have an assumption, and that assumption is there's a linear relationship between house price and living space. That some assumption might be not that bad for house prices, but in generally, we don't know those kind of formulas. Therefore, let's go for another example. For whatever reason, I now have a new price database here. And it might look like this one here. Those are prices of historical selling activities from your company. And don't question, please, whether those numbers are really right and good in the way, but those are the data. Okay, and you see what I have done. I have a more or less, not really straight line for the increase at the beginning, and then something which we would call more or less a saturation of that value. So that means from a certain square meter value, there is no big change anymore in the price. Okay, we know we can visualize all the data. It's easy for us. And if I now would give you the task, please predict me the price for a house of 225 square meters, you would immediately, I know that you would do the right estimation. But you can do this kind of task only because you look to the data. More formula and going later to thousands of data, always changing and so on, it becomes by far not that obvious like we speak and like we look for those data here. In this case, let's first try what we have done before. We built a trend line here, and of course, that trend line is not good. We saw that already by eye. That it's not a good idea to use that kind of trend line or linear relationship between, in this case, prices of the house and the living space. In this case, in just doing Excel, I might go for a polynomial degree 2, just for example. And then it would look like this one here. But honestly, that is really questionable, because you know what that kind of polynomial would do. So if you would go further down the road with increasing living space, we would maybe get more and more wrong data. It might be a better idea to use other polynomials, like, for example, a polynomial with 3, or I don't know, a polynomial with 4. And now this might look a little bit better within our data, whatever. Finally, everything is, let's call it wrong, or not wrong. That kind of assumption for an underlying dependency is difficult. And now the concept of k nearest neighbor is quite obvious. And by the way, the concept of k nearest neighbors would be especially the one you would do by your own if I ask you now the question, please tell me the price for a house of, I don't know, 225 square meters. Let's go here a little bit, 225 square meters. That is around maybe here. There's my, at that vertical line, we ask for the price. And the concept of k nearest neighbor is quite similar, quite easy. Draw a circle here, which takes for example, 3 neighbors. And then, for example, you calculate the average. So you use, in this case, you might use those 3 numbers because they have values on the x-axis which are closest, nearest neighbors to your value of investigation, the 225. And your prediction would be just that that average, and that's all. So it's a little bit similar to our concept within trading of moving averages, for example, but that is, and you can apply the same kind of concept for huge data, and that is the concept of k nearest neighbors. Let me describe you that a little bit better, or before that we do that. If we would use that 3 neighbor window and go around here, then we would more or less do exactly the same like this one here. We use a moving average with a period of 3, for example, and it would look like this one here. And now we have something which does not incorporate any assumption of any functional behavior. It goes, or it comes simply out of the data itself. And that is a big advantage of that concept, k nearest neighbor. Let me show you one website on that. Oh, I moved away from that. No, I have it. And there's a Wikipedia article, k nearest neighbors algorithm, and you can read it by your own, but let me just use a simple example for how that concept works. I only want you now to have a look on that one picture here, and that one picture with this one in the upper left corner. What we have here are 3 different colors in a two-dimensional, 3 different colors in a two-dimensional space. And what we want to do here with the concept of k nearest neighbors is we want to classify those values. And what does it mean? For example, if you look from the first picture to the picture to the right, figure number 2, then the concept of one nearest neighbor was applied for all potential points within that space. So for example, if we would have a new point exactly here, where my mouse is right now, we would say this one should be red, or would fall into the red category, would fall into a specific category of trading. Think about a long trade or a short trade or whatever. So we can use that concept in order to first to classify and then to identify the new point to which class it belongs. And you see, you can build those regions with the 3 different colors here. And you can use, for example, one nearest neighbor, or in this case, it's 5 nearest neighbors. And then you can ask once again, in what kind of category do I fall with my new point? You see slightly changes within here, and so therefore the regions differ a little bit, but the concept helps extremely with huge data, and even with data which are more dimensional than 2, because we cannot visualize those anymore. What I have done is, for example, I use 10 periods of rate of change. So my space is the 10-dimensional space in order to classify my patterns. So to describe the specific situation. using exactly what we have introduced or what I described here now for our algorithm all around that picture of rate of changes, looking into what kind of category do I fall right now with my new candle, looking to my history base in order to get those categories and the average prediction within one category, I can do the same job and get those rules, apply those rules for the future, and then, for example, I get pictures like this one here. That is once again for different kind of parameter settings, different how many neighbors I put into the basket. Those are equity lines. Once again, prediction, always in the future, based on the analysis of the previous history. So walk forward concept, we have the training window and the apply rules window for the future. And we have, for example, we like results like this one. And the black line, by the way, is still under calculation. Also, it's not finished up to now. It takes some time to get the results, but looks extremely promising. So that is based on a certain amount of how many neighbors I put into the basket in order to answer the question in what category do I am, and then within those neighbors find the prediction value and then apply exactly that rule for the next couple of candles. So that's the concept, that's the result, and I think you agree with me that it really looks promising. Still, it's only predicting. It's not already trades. So I know what to do, or that there is something to do. And it does not mean automatically that, besides the fact that my prediction is really good always, that not automatically means that I get positive trading results. For example, if my prediction would change every candle from plus to minus, from going long to short, I know for sure that finally the strategy would not be positive because of costs, because of spreads, of commissions, whatever. So maybe I need some additional rules because I cannot change my position all the time from long to short, because I have always to pay some money for that. So it needs more considerations, and to have something like a good prediction does not mean automatically I have good trades. So I know that. But it opens a very good field for trading, because I know already that my predictive power, let's call it that way, is not that bad. Good. That's for now. Be sure that's not all. I have done additional steps already, and let me just change one picture here. That's another consideration with different kind of parameters. Yeah, but not going into the details, but you see the curves go to the north, and that's exactly what we would like to see in our trading accounts. So it really looks quite promising, the concept. And both examples I presented here are based on that concept of K nearest neighbors, in order to answer the question, what are similar situations in the past? Then take a circle around those points, look what has been the prediction for the past, and apply the same rule for the future. So that's all. So that's for now. I hope I have brought a little bit into the concept, light into the concept of k-nearest neighbors. It's a methodology out of machine learning and artificial intelligence, and we use it here now for trading. But of course, that methodology has a much broader field of interest or application. But that is for sure. Good. So that's for now. I know it was quite theoretical, it was quite mathematical, but for me, I would really like to share those thoughts and those kind of concepts, because I hope that those will help you as well. That's for now. Thank you for attending the webinar. See you hopefully next week. Same time, same place. Have a good week. Bye-bye.